My name is Catrina. I run Strobe Ventures. We lead first institutional round into pre-seed companies, mostly in crypto. And the topic today is, are we running out of buyers or narrative? Narrative is kind of a dirty word because it implies ephemeral nature. I mean, I think we have proven, and especially from all the banking institutions coming on board, of saying, okay, technology here to stay. What we here to discuss is the risk reward of buying and how. So I want to open up the first question. Well, actually, why don't we do a round of introductions first?
Hey guys, my name is Ivan. I'm the CEO and founder of Quantum. Quantum is a quantum technology company for crypto analysis and post-quantum security.
Hi everyone, Thomas, partner at Strobe. We're a venture firm focused on digital assets, but also with a broader mandate based out of New York. We've made investments in things like Ethena, Sky, Morpho, Maple, and plenty of others.
Hey, my name is Joshua Lem. I run markets at FalconX. We're a prime brokerage focused on trading and giving market access to crypto to hedge funds and asset managers.
My name is Eylon. I'm a partner at Collider. We're the biggest venture fund and digital asset manager in Israel. Invested in things like Nexus Mutual, The Graph, EtherFi, and a few others.
You did pump.pum as well, right?
It's not on our website.
I respect that. We have a nice blend of private investor and on the liquid market. Why don't we, I'll try to get as meaty of a content as possible for you guys within 30 minutes, so let's jump straight in. From your respective vantage point on the private market and liquid market, how would you see the risk reward of buying here at this point in time? Why don't we start with Eylon? Buying in your context would be investing in private venture.
Okay, in my case, investing in private venture, I think it's a very good time. I think investing liquid is kind of like there's a lot more, call it parameters that you have to consider. But I think when you invest in private, the thought is like, in 5 years, will this company create value? That's kind of like the thought process. And I think it's kind of clear here that in 5 years, we're going to be in a way better place. I think we're seeing all these institutionals, they want to come on chain, they want to do stuff. The question is, what can you build that the institutions won't build themselves? I think that's kind of like a very core question. And yeah, I think there's pretty interesting opportunity right now.
Yeah, very much agree there. I mean, I'm sitting a similar venture seat, and the grifter has gone to AI and robotics, and this is not one you really want to hype up right now. So it's a great time to be a venture investor. I very much agree. So Joshua, what about on the liquid side? You have bird's eye view.
Yeah, I think there's a lot of ways to answer the question, right? Like, you have to divide the world between Bitcoin and stores of value like Bitcoin versus altcoins and other governance tokens. I think those two markets have had a very K-shaped like divergence over the last year or two, really, in crypto. And I think that's related to kind of the narrative, you know, the changing narrative around what crypto is, right? Whether it's something that is this like dollar inflation hedge that asset managers can allocate into for diversification, or is it some kind of technology that people use to build payments and, you know, novel speculation venues and things like that? And I think, you know, like from my perspective, a lot of the sell-off of the last year in Bitcoin has just been the erosion of this like store of value narrative around Bitcoin, the independence of Bitcoin as like a neutral asset globally. But some of these things are changing, right, as we speak. It's like there's ongoing discussions with around Clarity Act, and I think a lot of these things will really move the ball like towards the end of the year. So I think for now it's like very hard in the short run to own or buy Bitcoin here. Like people are either waiting like for a lot lower, let's say like 40K, or you know they'd rather buy it at 80K when we're kind of on the way up. And we're in a little bit of a no man's land right now.
Wait, I have a question to you. Was Bitcoin ever a store of value or a hedge against inflation? Like we really, really wanted it to be, but did it ever become?
I actually think, so my view is like those characteristics of Bitcoin as a neutral asset have deteriorated over the last couple of years. And it's in part because of the concentration into like large institutional hands, both from a corporate perspective as well as like these asset managers, large asset managers. I also think that Bitcoin lost its neutrality when it became like much more strongly affiliated with like, let's say the U.S. and like the U.S. kind of the government and certain, politicians as well, like kind of using Bitcoin as a core of their platform, Bitcoin or crypto generally. And it's really alienated like other addressable markets for Bitcoin, I think. So I think at some point it was. And we, just the market's constantly talking about how much, Bitcoin Saylor has and like what he plans to do with it. Like that's not really healthy for an asset that should be like a neutral store of value, like a bulk collateral asset that people can use to shore up, portfolios and derivative positions globally.
Yeah, I mean, really interesting. If I can ask a follow-up question. So when everyone, including crypto Twitter, everyone talk about, okay, 60K is no man's land, there's definitely be a letdown. Don't you think that's a little bit too on the nose? Like you have to think about, okay, who are the marginal seller at this point? And maybe that's contingent on Clarity Act, but like what, I mean, to an extent you can share, like what would cause this letdown from here?
I think mostly just what risk assets do generally, right? Like I think we've taken a lot of the left tail risk off the table in the last couple of weeks, just with where economic data is, and like the odds of the Fed actually hiking have come in a lot. So that has actually been helpful, as well as like some transparency around what Saylor wants to do with his Bitcoin. Like he's obviously announced like $1 billion plus like program to potentially sell the Bitcoin that he has and increase his cash reserves, and that orderly form of liquidation is something that the market needed to hear. So I kind of feel like we've actually removed maybe that like 40K scenario. If you look at how Bitcoin's traded the last week or so, I mean, everyone's kind of front running like positive developments on Clarity. Like everyone kind of knew they were going to leak the text of it just so that, to build consensus in Washington. But it's still very unclear to me, like if that will progress. But the risk reward is obviously to own it, I think, here in the short term.
Yeah, if you take a long-term view, for sure.
No financial advice.
Not financial advice.
NFA. Thomas, curious, how are you seeing the venture landscape now? You also said, similar city as me and Eylon, but the risk reward is buying, and what are you looking at?
Yeah, so I think people are predicting like the doom of crypto venture, and every crypto VC fund is rebranding to AI overnight, sometimes credibly, sometimes for PR. And volumes are at a, 3-year low or something for the last 2 quarters on the crypto VC side. That said, it sort of feels from our perspective like the best time to invest, just that the investment thesis has perhaps changed. I think Josh was saying like, we've got less marginal buyers for tokens, and the deal is more institutions coming in, and they're going to need to see more proof points. That's exactly it. Where crypto is less selling into permissionless use cases and new primitives, it's more a game of distribution for a new customer persona that demands to see more traction and that values companies at more reasonable multiples. If you have capital, it is a fantastic time to be deploying into better and better founders at more and more rational valuations. As one anecdotal, but I think powerful data points, the first 2 deals out of our second fund, which we're very, very excited about and have done with other tier 1 investors, are valued at sub $20 million on the token for the first and at a $6 million post on an equity deal for the second. These are numbers you wouldn't see for a credible deal in crypto 3 years ago, but you saw in fintech and consumer and in plenty of other traditional venture stuff for a long time. And I think that's pretty healthy, right? Because not every outcome is going to be, a token launch that goes well and sells to a thinning retail market to the point of this panel, or a multi-billion-dollar equity exit. So we're super excited. We're just, I think, more focused on what we hope to be the right use cases, and I think with the right investment horizon and thoughts about the entry point.
Yeah, I actually have a lot more follow-up questions there, but we have a dedicated venture section, so I'm going to park that for now. Another big level, higher level question is, as buyer look to underwrite, especially on the liquid market, do you see this convergence between crypto valuation method rubric versus public equity? Like, do you see them converging, or you still see this crypto premium persist over the next cycle, or if that is still a thing?
I'd love to kick this off. Like, yes, I think tokens have obviously carried a premium, and crypto in general for, 2 or 3 reasons. I kind of bucket it as like a liquidity premium from tokens early on, whilst there was demand. Maybe a narrative premium, to your point, marketing goes a long way, and then some kind of a venture growth, early stage, small cap premium. 2 of those 3 are gone, and the third is maybe less exciting given crypto is more mature, thus the return profile has compressed. So like absolutely things have compressed. On average, I think like private companies in crypto used to raise at 2x token warrant multiples. So like essentially crypto had a 100% premium to the real world on the equity side. That seems to have inverted right now. Like tokens generating hundreds of millions of dollars of revenue are trading at lower multiples than equity peers. We've got some in the portfolio where we think they're due to re-rate, and we hope to see that. You're even seeing, for the first time, token protocols wonder if they should go the other way. I'm sure we're all familiar with the across protocol news, where they actually went and put that to governance. So yes, there's been a premium. I think it's compressed. It's probably compressed overly so on the token side, and we still have some growth, hopefully, as an early stage asset class with institutional outcomes to deliver. But the first two easy wins have, kind of thinned a bit.
Yeah, well, a corollary question to that then is, if it converges, that means a lot of things will be underrated only based on fundamentals. That also means based on, even now, I mean, we think the crypto token market is as depressed it is, but most token are probably looking at a 95% drawdown even from this point on if revenue is the only rubric going forward as people look to buy. Would you agree? Like, basically, most tokens, 95% down, and everything's revenue-based?
Yeah, I'd like to give an example that is very recent, right? Like Robinhood launched the chain, right? And then the first thing that happens is like Arbitrum is up 20%, Uniswap is up 20%, Morpho is up 15%, right? There is no actual revenue flows back to the token, to either of those. There's like a tiny thing that flows back to Arbitrum, unrelated to the token. Uniswap, whatever volume is being done on Robinhood chain, does not flow to the Uni token. And also Morpho, like there's no flows back to the token. And so in crypto, it's like narratives change things or like create flows into different
growth
assets.
for those three, I would argue. Like those are three products that have escaped velocity. You don't see many things with billions of dollars that could eventually turn the lights on monetization. But yeah.
But I mean, in essence, it's like some narrative happens, and then the collective, whatever retail mindset of crypto, it just goes and buys things, and through flows that don't really make sense. They're not grounded in any sort of reality. And I think if you look at the public markets, right, like SpaceX, the valuation of SpaceX is not actually grounded in reality in any way or form. I guess you can say whatever, the Elon Musk premium or whatnot, but it will always be like a percent of the value of an asset that is just completely speculative.
Yeah. I guess there's also a time factor here because Arbitrum, for example, I think they're generating between 30 million to 50 million of revenue through various streams, but they haven't turned on the fee switch, right? Even on a public market, when we're taking that parallel, you're not really forcing any public company to do cash 50% buyback in year one. It's more so their potential to grow, right? And then I'll take the other side because we, as we lead the first check into pre-seed companies, and obviously we still back pre-product, pre-revenue company. Like revenue is not the only thing. And actually, in most of the cases, I only have revenue when we back. And there still needs to be dollar going into the disruptive technology, as I call it. You always gonna have a hockey stick downward and then upward. Even, for example, Yvonne sitting here, Quantum, you guys are not revenue generating at the moment, are you? But tell us more. I don't want to put words in your mouth. But.
Yeah, so I think a lot of what has been said here implies that it is all stocks, all cryptos are the same. It's not. So if you can think about the future, and I think that makes a lot of sense if you say layer 2s generally have a bad time now because layer 1s, for example, are trying to consume it. So why would you be super forward-looking for a layer 2? With Quantum, if you look at the public stock market, none of those companies have meaningful revenues, but they're trading at billions and billions of dollars of valuation because the people who invest in them see it as a future bet. So we know that in the next 2, 3, 5, 6 years, quantum computers will become more prevalent, people will be using them or businesses will be using them, and that's why people are betting on this future. And that is kind of the same here. So we are taking quantum computing and saying, okay, this is very relevant for cryptography. We don't really think about ourselves as a token business at all. We will most likely never have a token. We want to do an equity story, but the equity story is, okay, quantum computing is relevant for cryptography. Public buyers like that, private buyers like that. It is proven that it has an impact on it, a major impact, which we can also discuss. But that is what people want to buy. They want to buy into the future. They don't want to buy some old school tech. It's like if you go back in history, the car was invented, you would be very bad off if you bought, let's say, horses.
The market wants fundamentals or high growth or a combination thereof, but less narrative catches less of a bid than it once did, I think is what we're saying.
And the cycle is also shorter. Eylon, you had an interesting article about, it's called "This is the Last Stop of the Train." Tell us, I mean, it was a pretty good encapsulation of, I guess, what happened in the past at least 2 years. Like, tell us, give you the TLDR.
Yeah. So I like to think about this. Any fans of Hegel here? Probably none. All right, there we go. So there's like this thing about the Hegelian dialectic, and that's how progress is being made. And let's say, there's a status quo, there's the rebellion against the status quo, and then there's the integration. And so like fiat money was the status quo, Bitcoin was the rebellion against the status quo, and now we have kind of like the financial system that is being kind of woven together, which is the combination of the two. Previous examples is like, Napster was a rebellion against whatever the CD companies.
I worked on that deal, by the way. Yeah, I took from public to private. Yeah.
You worked on Napster? Oh, wow.
Worked on that deal, Napster, from public to private market.
Nice.
Yeah, high five.
So Napster was like a rebellion against, the CD companies, and then, the integration is Spotify. And again, with like torrents, and the integration is Netflix. And we're seeing the same thing here. And there's like no more rebellion. The Wild West is kind of over. We're now waiting for all the financial institutions that are here to upgrade their rails, come onto blockchain. And it's basically over in terms of like this phase, call it, of the rebellion. I think once that phase is done, right, and we have a global 24/7 financial system that is not permissionless, but it's instant and it's programmable, we'll have like various new applications of how money works and how money travels around the world. And I like to say that like maybe one thing is I earn treasury bills in US hours, right? If money is instant, I can earn on my my treasury bill from US open to US close, and then once that US closes, maybe some guy in Singapore borrows my dollars, and now he trades, and it gives me like more yield while I'm asleep basically, or while the markets are not open. So that's kind of like an interesting concept that I think will happen once this phase is over and all the financial systems are going to run on these new rails.
That's super relevant to the question I was going to ask next, in the sense that, as venture investor for us, we underwrite standalone outcome, a standalone IPO, standalone token launch, when token market is good. However, now we are in the integration phase where, blockchain meets Wall Street. So have this changed your way of underwriting instead of just a standalone outcome to look more into the potential M&A outcome opportunities?
I wouldn't say it changed it, because that was our thesis 3 years ago when we set out with our Fund 1. We were very equity friendly compared to what was in favor at the time. And I think like without over trying to bucket things into specific allocations, it ended up being pretty much in equilibrium. And even in the token outcomes, we've bet on tokens that have been able to go and work with Janus Henderson, like an Ethena recently did, or a BlackRock even that they also partner with. So we've, I think, placed importance on the more financial side use cases of crypto than the more casino sides of use cases of crypto. That's been our thesis as a firm. And that's led to underwriting a different type of founder that I think was looking for this stuff. So in that regard, we've been excited. I think we're looking to V2 primitives now. I think a lot of the V1 primitives, even for the more permission use cases, have been built. Like, we are less looking for the nth new yield-bearing stablecoin right now. We are more looking for businesses built around stablecoin issuers, whether it's for agentic payments, payments dispute resolution, and those tend to be founders who have worked in regulated industries, who understand distribution, who are perhaps a little bit older than the prior cohort of crypto founders that were very ETH Global Hackathon friendly, if I kind of bucket categories. So that's a little how things have evolved, more so than the overarching framework for us.
Is there a comment there? Otherwise, I can go to the next one.
I mean, I think I'll say, like, with respect to equity versus token alignment questions, like, unfortunately, I think we're in the part of the cycle where it's like very hard for new projects and founders to get financing to build things unless there is some token attached to it. And like, it's obviously better to do a token in a bear market than it is to do one, I think, in a bull market for like long-term value accrual to the token, I think. Your point earlier was that most tokens will go down 95%, and I think that is true. I think that's true, and I think that's what should happen. Like, I think that's what should happen is people should use tokens as a way of like capital formation, raising money to fund new ideas, to bridge the gap between like what they're building now and future demand. That's always been what tokens have been, right? Like a pull forward of like future revenue and cash flows. And you kind of need that bridge, and you need, real-time liquidity and market validation of the idea in the form of like a liquid token price, I think, in order to have like meaningful investment and innovation in crypto. So, I mean, I think you're right, like things will go down, but that's a necessary thing for you to discover something like a hype.
Yeah, I want to say maybe a few words about M&A. I think the fact that you don't have many companies that can acquire like crypto, smaller companies, I think it's mostly like Coinbase and Kraken, right? Maybe Polymarket a bit. But the fact that you don't have that middle layer of like, you know, there's could be a crypto company, they're generating $1, $2, $3, $4, $5 million, and it's not enough to be a private equity. It's maybe like some sort of a search fund, and this doesn't exist in crypto. So that gap is kind of like many companies are not becoming anything at all, and just die. Which kind of sucks, especially now in the bear market. We've seen already a lot of companies close, and there will be many more. Yeah, it's a shame that they cannot be absorbed into some kind of like other vehicles or other companies that are building things like generally in the space. And then, so like the outcome is either, you know, token launch, Fugazi, billions of dollars, an acquisition, I don't know, like Echo and that type of thing. And there's just like nothing below it. Like we've seen very little, you know, $10, $20 million acquisitions.
Yeah, I think they happen also just kind of in stealth because nobody wants to report on that.
I'd actually argue the M&A interest and buyer profile has greatly increased. Like our companies are being approached by TradFi companies they never would have spoken to 2 years ago. And oftentimes when the M&A conversation isn't being well received, it can catalyze like a strategic round. So perhaps it also depends on the use cases. That tends to be the more like institutional exchange, doing regulated futures or the RWA plays than it does some of the other stuff in the portfolio. I do take your point, but like,
but those who have a token, it's like, we're gonna figure out how to M&A a token.
yes.
It's like,
and you have, but even there, you've seen examples, right? Like Circle
yeah.
acquired Axelar, and the token's still trading and trading to zero. Like we do have a lot of zombie tokens, sometimes for good projects, sometimes for bad projects. The bad projects probably trend to zero, to Josh's point. And structurally, it's hard to make your way out of a bad token, even if you have a good project.
Yeah, and I mean, in those cases where it was just like, hey, we're acquiring so-and-so company, the token is not a part of it. It's basically a big, you know, middle finger to all the token holders. And this has happened like multiple times, which is kind of, okay, so maybe as a token holder, you weren't entitled really to anything.
But that touches also the fact that tokens have a regulatory arbitrage since ever. So tokens were always regulatory arbitrage. I'm doing something quasi not legal, like hyperliquid, let's say, non-KYC SEX. The only thing I can do is launch a token. I cannot launch equity. And to that extent, you basically get these types of things, right? If there's no legal regulation, I can just do that. I have a token, well, yeah, it doesn't do anything. I'm getting acquired. Typically, the equity would always be part of that, but the token isn't.
I think the other piece is there's very few companies that have launched tokens where it's very clear that they're driving the value only to the token. Like I can think of maybe Morpho, maybe Sky, maybe Maple, at least in my portfolio, where it's like, there is no equity that's investable. Every other token that's been launched in our sample also carries equity with a venture cap table. And so like the incentives are blurry for the issuer and for the market. And over time, that's probably something that changes. But right now, it's the industry self-policing itself. And let's face it, it's not very good at it.
How do you guys advise your portfolio company if they have on-chain revenue? Like, should they have both equity and token value accrual, or at least have two separate? Or from a hedge fund perspective, I mean, there's one version I've heard and collected feedback on. Like, it's just one instrument. There is no ambiguity, right? So, what would you advise your portco?
We prefer one or the other. When we do cost basis allocation into an initial investment, we actually underwrite on the basis of a set of questions and criteria, whether we think this will be a token, whether we think this will be equity, and where we ascribe the initial like investment value. So we think of it as one or the other. Having both gives you some flexibility along the way. Sometimes things change, but we try to underwrite towards one outcome.
Yeah, I think like we look at this the same. I think at the end of the day, if you kind of like look long term, it has to accrue into one thing, because then you're just whatever fucking with your investors, fucking with your like token holders. Like it has to be like one thing. And the thing is, you couldn't do it. Like up until 2 years ago, it was completely in the dark. I think the SEC basically said that the only thing you can do is meme coins, right? It cannot accrue any value. And now it's kind of coming back. We're waiting for clarity. We're waiting to see kind of like how the regulation will actually evolve. But these two will converge, hopefully.
Josh, I mean, you're the ultimate buyer, or you have oversight into what buyers are buying. So, I mean, equity, token, how are you thinking?
Yeah, I mean, I think the last couple of instances, I think you mentioned Axelar, other projects that have been acquired where the foundation just becomes like an orphan effectively. I mean, it's really turned off like long-term asset allocators who would like to own tokens that are aligned with projects that they see that have durability, right? Like they don't want to own the token if that's going to be an eventual outcome. And I think that's a major overhang for the space. I do think that there will be the issue is like tokens are by design not tied to like shareholder rights, and because if they were, they would be fully regulated as securities, right? That's kind of like what the trade-off we've agreed to as an industry. And that's now we're facing the consequences of that, which is that basically most tokens like do actually go to zero because you don't have any rights to cash flows. So that's like, but you know, I do think, like I said earlier, if you do have a good idea that requires like immediate investment and engagement with like ecosystem partners to build and grow traction over time. So I actually think tokens are maybe more appropriate for like markets businesses that rely on network effects. If you have that, then you do actually want to launch a token. And then in the long run, like the value accrual comes from buybacks, from cash flows.
Awesome. Well, we have 1 minute left, but can we just do super rapid fire? What would you buy in the next quarter in crypto? You can say nothing also.
Hyperliquid.
I mean, my head of compliance is sitting right there, so this is
You
tough.
can just say
but,
venture investment. We're both deploying.
We're very interested in the insurance and fintech layer on top of prediction markets and crypto rails. So like perps on compute, insurance built on top of Polymarket and Kalshi. Those are areas we're actively digging in right now that we find exciting.
Interesting.
All right. Well, as a derivatives guy, I gotta say like maybe call options on Bitcoin just because, you know, risk premiums at like near all-time lows, right? For crypto and for Bitcoin specifically, a lot of it's like technicals from this overhang of Sailor and the supply of just like constant overriding flow from ETFs that are yield generating on top of Bitcoin. So I do think like there will be a time where a lot of these short-term negative overhangs are out of the way, and you'll see like a large pop because Bitcoin's, I think, very underowned institutionally.
My question is, what is the time horizon?
I said a month from now.
Oh, for a month? Hold it for a month?
A holding horizon.
Yeah.
Oh, I mean, you can define it. Just give
So
us some alpha. That's all.
I think the interesting thing that is not as well hyped right now is Pearl, which is, I don't know if some of the people here heard about it. It's kind of like a way to produce tokens with proof of useful work. And there's a whole network around it. I think it's still mega, super duper speculative right now. But if they can capture more, whatever, GPUs to run this, like there's a meaningful, I don't know, way to bridge US dollars to compute and back and forth. It's kind of like a bridge. And I think that's kind of like, that will be the holy grail of crypto. If you can move from dollars to spinning GPUs that run AI back and forth, it's a very interesting kind of thing of the future. Kind of like, you know, spot prices for oil after whatever the 1970s when the Five Sisters or whatever they were called broke up, and the Middle Eastern countries basically took ownership of their oil and started selling them in the open market.
Yeah.
Yeah.
The King of Oil. There's a book about that. But alrighty. Thank you, all panelists. Hope this is meaty enough, and enjoy the rest of your conference.
Thank you.